Today, Bitcoin hits another record high. Around 10 a.m. Eastern, Bitcoin touched a new all-time high of $72,992.
Gold rush, the precious metal soaring to a new record high today, topping the $2,200 mark for the first time ever. It just notched its best week since October and is up 20% over the past year.
Both the central bank and Chinese firms of gold. And I do wonder what we read into that. Is that a diversifier away from the U.S. dollar?
It absolutely is. In fact, it's a diversification away from any foreign currency.
Welcome back, everyone, to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. What does record gold and Bitcoin prices mean in the stock market for 2024 to 2025? We have just witnessed gold breaking out to an all-time high close to $2,200 per ounce. And Bitcoin went on making a new high of $73,000 per coin. The stock market is also making new highs. Are we supposed to be in a Fed tightening cycle? Or, just like the Fed said, inflation is transitory in 2021. It's exactly the opposite from the truth. Even Tuesday's CPI data comes out hotter than expected for February of 2024. So what's really going on? What's the record gold and Bitcoin prices really suggest here? What's my prediction for the stock market from the rest of 2024 to the next year, 2025? Full disclosure, I do own gold stock and coin stock in my YouTube portfolio. If you are interested to see that portfolio, check out my website. Link is down below.
Getting rid of it would benefit Mark Zuckerberg and Facebook. Actually, right after he said that, Facebook facepalm. That's facepalm, face planted. I saw Facebook just tank like after he said that. I was like, wow.
First of all, in order to predict what's going to happen in 2025, I have come up with two totally different scenarios. So deep diving into policy and understanding the monetary direction, both short and long term, is important. My assumption is that there's a 50-50 chance that there's going to be a policy change.
Start the questions, I'll get in trouble. Anyway, am I allowed to take any questions?
Not knowing the outcome of the election, if there is no policy change, I will assume that's the reason Warren Buffett owns over 30% of Occidental Petroleum, because I believe inflation will come back hotter. Maybe the second wave of higher CPI prints will start and CPI could be higher than 10 before we know it. And oil stocks will go on a big run, and oil price going back higher due to supply chain shutdown again. Of course, for the cannabis stocks, DEA will more likely to reschedule the Mary Jane industry if there's no policy changes. People will be given more checks to solve their inflation problem, which will make the Fed's job even harder. They might even raise rates higher than 6%, which could potentially crash the market at the end, just like 2022. However, if there is a policy change, if we drill, baby, drill, then obviously oil stocks will go down because supply will be overwhelmingly above demand. However, for the EV industry and cannabis industry, Houston, we may have a problem. Cannabis rescheduling might be delayed again if we have a policy change. These policies are very powerful. They can really change the fundamentals for the stock and even bond market. If we drill, baby, drill, then oil price will go back to low 40 range, which will likely cause inflation to go down faster than expected and even go to negative, which will be like China. We will have what everyone has been talking about, the recession or deflation, which will be an unemployment recession, meaning people will lose their jobs. Then we could have a stock market crash and a hard landing reset finally. We could potentially buy Nvidia and other AI stocks for a discounted price. Then the rate cut will finally happen and the Fed will drop the rate down to maybe 2% or even 0, just like 2020. Then the stimulus comes and we are having another stock market rally like we have never seen before. That's my long-term view for 2025 and beyond. But what's my short to mid-term prediction? Based on what price action for Nvidia, which leads AI stocks and overall tech stocks, which is the S&P 500 index, I think the stock market will be finding a way to correct itself in May. Like they say, sell in May and go away. And the second half of October will be a near-term bottom, followed by a Christmas rally. Overall, a positive year for the stock market. The fact is that the backdrop of sluggish economies and policymakers that probably want to stimulate growth is the best outlook one can imagine for the stock market. Right now, we're in a bull market. Bull markets last on average about 2 to 3 years. This one has been running for about 17 months. Druckenmiller said this AI bull run can last 2 to 3 years.
I think that some areas of the market, particularly in AI, start to look like they're in bubble territory.
But I do believe, unlike crypto, I think AI is real. It could be as transformative as the internet. It's a huge thing. And I think I've argued publicly that if staples can go up in price in a recession, why can't a company like Nvidia, if their orders and earnings go up 70% in a hard landing, which is what I think would probably happen, it's not clear that Nvidia goes down despite the lofty valuation level. History has proved that if you have very good earnings in a recession and they're sustainable. Nvidia bottomed in October in the low 100s. It's true it's 380 or 390, it's in nosebleed territory. If this is a secular move, if this thing is real, you just don't have 10-month moves. That's not how it works. Even the dot-com bubble lasted 2.5 years. For many of the guts of the internet, it lasted 4 years, the Ciscos, the Sun Micros. So could Nvidia go down materially in the short term from any point? Yes, but I would be surprised if I'm right on AI and the impact on it. I mean, it's already making the top coders 7 to 8 times more productive than they were 5 months ago. If it's as big as I think it is, Nvidia is something we're going to want to own for at least 2 or 3 years.
So 2 years are 24 months, 3 years are 36 months. So we are halfway there. October of 2025 will be year 3. That will be the time a recession must happen by then. Generally, if you look at the math of this, I'm taking the S&P 500 as a benchmark for an average cycle. You should have seen by now about 60% of the normal gains in a bull market. Markets are going to get some decent returns over the next 12 to 18 months. But it's going to be more difficult than it was in the last 17 months, that's for sure. Technology is always an early cycle mover. Bitcoin and cryptocurrencies have clearly got the momentum going. At the moment, they're very, very liquidity sensitive. As for the liquidity, it drives the market, especially for Bitcoin prices. Now that we have Bitcoin ETFs, I think we get a liquidity pullback. In the short term, as I see a correction on Bitcoin and gold price before they continue higher. Here is a chart that is showing the Federal Reserve balance sheet, which is the red line that is measured on the left side scale. And that's shown in billions of dollars. So what you've seen is a Fed balance sheet which peaked at around $9 trillion and is currently edging its way down to about 7.5. So there's been a very slow decline. But what that red line shows is actually the QT program. There was a step up at the time of the SVB crisis. The more important line is the orange line. The orange line is measuring the net liquidity injections of the Federal Reserve into US money markets. So in other words, this is the net footprint of the Federal Reserve in the markets. And that orange line is clearly inflected and going up. And that's why financial asset prices have gone higher now. As well as I've extrapolated through mid-year what I think Fed liquidity could do, and there is that nasty step where liquidity goes up but then comes down, is almost entirely accounted for by seasonality in the Treasury General account because of the tax inflows that I would suspect certainly beginning through April. Let me show you this chart. This is just something which I think is worth dwelling on for a moment, which is saying what phase of the cycle are we in? Now we're in the early phase of the upswing. In other words, from the trough through the midpoint of the cycle, that is what we label as the rebound area. You can see on the traffic light diagram in front of you that we basically show on the left-hand side asset classes and on the right-hand side industry groups. The 4 seasons of the investment cycle, rebound, calm, speculation, and turbulence are labeled there. And in the rebound area, what you'd expect to perform, and what I should emphasize here is this is not a sort of fitted data set. This is what history shows on average in these cycles. So you know this is a cross check. If you like to see whether we're in a normal cycle or not, let's look at the asset classes, equity, credits, commodities. Bond duration means long bond. What you would normally expect during the rebound phase is that you'd expect equities and credits to be the big outperformers. During the rebound, that's pretty much what we've seen. Many people were skeptical, particularly about the credit markets, certainly about certain areas of the equity markets, but they've been proven wrong, and both of those asset classes have been strong performers. Commodities have not been good, but they may be coming to their own soon. And I would argue bond duration is not a great area to be. And I think there's a distortion in the bond markets anyway, but certainly we're now seeing the bond market selling off. As you move to calm, what you'd expect to see is equities continuing to motor. You'd expect credits to not be great performers. Let's say the shine comes off credits. Commodities take their place and you still don't want to be in bonds. And then if you look at the industry groups, it says that in rebound, you really want to be in cyclicals. You don't want defensive stocks. Initially, you want technology stocks. They will likely be the leaders, but as you move towards the calm phase of the market, as liquidity gets a lot more momentum, behind it, technology keeps going. Financials and energy start to come through as other assets. I would suggest you looking at big US bank stocks like Bank of America as a good bellwether of financials doing well. Like I said, in October of 2025, we will be hit by a hard landing. It will be represented by the turbulence phase in this diagram. If you start to see financials outperforming and you see energy stocks beginning to get traction, commodities like gold beginning to lift off, then that's pretty much confirming that we're in a calm phase.